Good afternoon. My name is Chuck Evans with Lenders Cooperative. Welcome to our 30 at Noon webinar series. The purpose of these webinars is not to replace the great training that we have at NADCO and NAGLE or even the SBA, but to bring you industry stakeholders that have some good perspective in their areas of expertise. So today I'm excited about the panel that we have. David Tinsley, Senior Vice President at Lenders Cooperative, works with me. He manages the LSP team in Birmingham, Alabama. Manny Flores from SomerCor, the CDC in Illinois, and the home of our new administrator. Am I right, Manny?
Yes, you are.
And then there's Brent Ciurlino, former Office of Credit Risk Management Director and now Chief Operations and Risk Officer for VelocitySBA. My friend Michael Johnston, who was a national manager of a large SBLC, has now gone back to the bank and started a department at Bankwell in Connecticut. And last but not least, Hilda Kennedy, one of my good friends, and I'm happy that she's president and founder of AmPac Business Capital. So welcome, you guys. We had Lance Sexton that was coming on, but he hasn't made it, so we're going to just continue. David, before we move on, can we get the commercial out of the way?
Sure, that's right. So
Thank you.
Lenders Cooperative, it's a company with our parent company, AmPac, that's focused on technology, both to support the private and public sector, as well as our best-in-class lender services group. How's that?
Thank you very much. That we keep everyone happy, right?
Right, that's right.
Okay. Well, the first question that I have is for Michael and David, who just got back from Malk. Could you share with us a little bit about that conference that was Monday, Tuesday, and Wednesday? What surprised you? What didn't surprise you?
Michael, you want to go first?
Yeah, I would just say as an industry person, probably what was kind of for me was, a lot of times when you have the SBA personnel there live, it's very helpful. They were in a position in which they were able to communicate with us through a couple of the seminars and then finish up at the last day, through Washington at one of the conference centers where they were, collectively talking to us. But I think sometimes being able to shake their hands, see them, is very helpful, I think, from my perspective. But, I think the underlying tone is that there's changes coming. We've seen some already enacted, and some of it is, I know that the SBA Connect call is coming up soon. We've also got some things that, I would just always encourage everybody to be aware that they're touting. One of the things for me as a new lender kind of in the market that I'm working on is that they're really pressing hard about responsibility and accountability with the lenders. And with that being, one thing that I'm working on is referral agreements and how that OCRM is now pushing back on the lenders to be responsible for their agents, is that they would call them. So if you are using and working with referral partners, paid referral partners, there's a responsibility that we have to, that they're holding us accountable to what they're doing and saying in the marketplace. So things that I don't think for me was necessarily something that I'd always thought about, but it's something that has become very prevalent. And so they are kind of pushing back. So I look at it as if it's as simple as that, you need to be very cognizant of the fact of what's going on beyond that. So just, I think Brent has brought it up in the past too. It's like, kind of dotting your I's, crossing your T's. Be very careful about how you approach things, but read into things as they're going to be making these changes, and be prepared to make those adjustments, because they are going to, better or worse, they're going to hold us accountable, basically, is what I'm hearing.
And as an LSP, there's a much more of a focus on third-party vendor management, I think. We've seen changes in how they review lender service provider agreements, and it's all welcome. I think that it's time, we're an unregulated industry, and the only way that we're going to keep everyone between the white lines is to have those kinds of actions, I believe. David, what do you think? What did you learn at Malk this year?
Well, I have to agree with Michael on that, though. Certainly, I've always enjoyed having people from SBA there. I know Michael was mentioning that they'll, answer your questions, or in my case, I chase them down the hall afterwards to ask the question that I didn't quite get to. But it's definitely you could feel the effort they were making to be present while they weren't able to be present, in that way. And especially there was a huge panel at the closing session that they had nearly all of the heads of the various groups that were there answering and kind of giving some anticipatory comments on it. And we heard it from more than one source that do what you do is being walked back. I mean, that's, we know that's not a surprise. And so there were some hints at what that might look like, but I think the takeaway for everybody is be on the call next week. Everything was going to be getting updated. Obviously, the hints at the new SOP. So we are all waiting with great anticipation there to find out kind of what's different. But I do agree with you, especially around vendor agreements, oversight, at least from Okram's perspective, that you've got to be doing that. None of those things in and of themselves were unreasonable. It didn't feel that way. This was not. I think all of it could effectively be housed under the concept of, prudent lending, just reasonable commercial practices, and so on. And so when you were digging into some of them within a few of the breakout sessions, I don't feel like no one was walking away feeling like, what are we going to do now? This is a completely brand new thought process, So I liked it. I think it was a very positive feel overall. It's almost as if it's not our first time to see big changes, so we're ready. It felt like that was the vibe there. I don't know if that was a Texas thing or if that was as much that's how hardy SBA people are. I like to think a little bit of both, but anyway, that was sort of my takeaways.
Well, we have NADCO coming up. Was it 2 weeks, Hilda? Something like that?
2 weeks, yeah.
So Manny and
24.
Hilda, just share with me what you think, what you expect to hear from NADCO that's any different. What's the good? What's some concerns? You're on the board. Maybe give us some insight as to what the agenda is going to be in a couple weeks.
Yeah, I think that NADCO, one of the things that we've been looking at is we've been looking at the data. And the data shows how strong the SBA 504 program is. We're at zero subsidy. It's a program that enjoys 3 looks: the bank, the CDC, and the Sacramento Loan Processing Center. So it's no wonder that our 18-month default ratio is less than 0.5%. And the program remains really strong in terms of default and even early indications of default. So I think that what we're planning to hear at the NADCO conference is keep doing what you're doing in terms of being responsible from an Okram perspective and from a default perspective, being prudent lenders. I think we're planning to hear manufacturing is a big deal. And because manufacturing is a big deal, we need SBA 504 lenders to be prepared to serve manufacturers and made in America. We fully expect to hear that, and we know the SBA administrator did that press conference in Indiana at a 3-time 504 borrower. So we feel very good about the things that we have been doing as an industry and the things that we'll continue doing as an industry. I don't think that there's any new changes that will shock us, although there are some things that we have to do now that we didn't do before, like environmental reviews are required of us. And one thing that we're all wrestling with, though, at least in my state, and probably Manny may have this experience too, the citizenship requirements, the new citizenship requirements have been a change that has affected some of our borrowers.
It was a big conversation at the last conference in North Carolina, having to certify 100% of the ownership. And I don't think we've heard anything different from that, have we?
No, we haven't, and we've been advised and already through the processing of loans to make sure that we're in compliance with that requirement. And a lot of that is going to require education and engagement, letting our third-party lenders and other community stakeholders know up front about some of these changes. I do want to touch just on one point on the
Please.
reference that Hilda made related to manufacturing. We were excited to also here in Illinois host the new administrator, Kelly Loeffler, and Chuck. I know you made reference to the fact that she's originally from Illinois, so we're very proud of the fact that the administrator is from Illinois, and she visited Peoria, and it was great to have the SBA leadership, the new staff that is they have a new manufacturing a dedicated office and staff. They visited with local manufacturing organizations, companies, but also organizations that are helping in the economic development space provide technical assistance, and also met with local congressional leaders. So that sends a very positive message, and one of the things that I'm really excited about, and I know that Hilda's excited about, is that here we have a loan program that has a very long-standing track record, and then now how can we continue to build on it to really help grow our economy? And one of the things that we're excited about as well is that you've seen some of the changes in the 504 program actually make it easier for larger size companies. So you have a broader range now of companies, from we still service a very small to now up to really middle market companies in some instances that are helping create more jobs through the investment and taking advantage of the 504 loan program. So super excited about the upcoming NATCO conference. And I just also want to reference, the Small Business Administration in my part should get a lot of credit for their level of engagement. And one of the things that we've seen now, I've been in my role since 2018, so seen several different administrations. And I know some of the members here have probably been in the industry longer than I have, but there has been a level of consistency when it comes to making sure that SBA staff is making themselves available to us. I know that in the NATCO conferences, there's a lot of engagement from the SBA staff. So I look at this as in a glass half full, in that I know we're going to be getting a lot of updates from SBA staff in terms of upcoming changes and how that's going to affect our ability to serve our small businesses and third-party lenders.
Well, that raises two points. I think the 504 I'm passionate about, and the last couple of years, and certainly now with this administration, it's moved to the front of the class in some respects. In other words, it's going to be a focus. We're going to be doing more. Am I right?
Yeah, I completely agree with you. We're excited that the administrator, Kelly Loeffler, is going to be at the NATCO Spring Summit. The NATCO board had a chance, the NATCO staff had a chance to meet with her early on during her transition. So she's really made the SBA 504 program a real priority because of the significance that it will have in building small businesses and the economy going forward, and especially this commitment to manufacturers. The 504 program will play a great role in that, and we're excited about that.
It's awesome.
I believe your NATCO board is going to be meeting with her before the conference also, correct?
Correct. That is correct.
One thing I'd like to convey, these conferences that we've attended over the years, they've taken away the travel budget for headquarters folks. And so we're going to see them at NADCO, we're going to see them at NAGLE, but we're probably not going to see them at Malk, Flagle, America East. And that's a challenge because some of those conferences serve the 80% of the lenders that do 20% of the volume. And it's oh so important to have headquarters people there shaking your hand, getting a cup of coffee with you. So I'm hopeful that that will change over time. Let's talk a little bit. Yeah,
Chuck, can I interject? Don't forget
Sure.
that we've got the ability to enter the questions in the chat. So I'll be monitoring those throughout as we go, and I'll bring them up but please, just everybody, it's a Q&A option. Please feel free to enter a question. We'll address it as we go.
Thanks, David.
Yeah.
Let's talk about the guardrails again, because that's been a big deal the last 2 years. As a lender service provider, we've been helping our lenders, our clients, with reviewing loan policy. A lot of people have went back and looked at their loan policy. In another month, we're probably going to have to do it again. Let's talk about how you feel the guardrails and what you think is going to change over the next month. Brent, do you want to start?
Well, I think the main issue is getting back to in a 7A program is going to be the fundamentals of credit. And, don't, I guess, not trying to do what we'll call a fintech-ize your lending process. I do think there's going to be support for small loans, but I think they want to go back to, for
350?
instance, are we going to have the authorization again instead of a terms and conditions sheet?
Yeah.
Okay? And then follow something and then have some parameters or structure around the expedited loan underwriting so that because they're very concerned about early defaults. So I think if people stayed with their core credit elements, they're probably going to be okay. I know we did not change our policy and procedures too much. We looked at our, I'll call it risk capacity based on our Paris metrics and said we have room that we could be a little more risk taking. But we didn't go to do as you do. We wanted to stay with fundamental credit. So I think you might look back towards what's fundamental credit underwriting, and then make sure you've got some other parameters that make sure you can verify that the loan can repay. And that's the main issue when you're in SBA and whether you were talking about community advantage or small loan, great, you have a score, but are you documenting that you feel like the folks can repay the loan? So I think a lot of lenders stayed with their fundamental credit. I think we got to be wary of, and I'm not saying the fintechy as a bad thing. You can't just keep pushing small loans through the system because you can package them and sell them to the secondary.
You can. Yeah, exactly. Yep.
And play the numbers game. So I do have some other things to say because I recently went through a risk-based review. And I also want to say that, if you remember the days when I used to be able to give the speeches about developing Paris and Smart and bringing in the contractors. So the contracts for the auditing is probably going to be coming up for renewal. And that includes 504, it includes the 7A, Williams Adley, and it includes, there has been no SBLC audit firm. So I know they're working on a new audit set of contracts to go out and bid. Going back to what David and Michael were talking about, I had extensive questions, and I do have a questionnaire sheet that I received. It's like 12 pages of information that SBA asked for that's included an actual third-party management procedures and an LSP/third-party management oversight plan. And there's actually guidelines out there, but they've never really made them available. Luckily, I kind of talked to, let's say, Ethan Smith and some other folks and got some of the guidance, because I don't know if people are aware of the guidance that SBA's put out because it's been in notices and such, but there's some very stringent requirements relating to this third-party processing. And Michael, if you're back at a bank, you know what it's like at a bank. While I was at the bank during COVID, FDIC and OCC and the credit unions were heavily focused on this third party. And Eddie Ledford really looks at what FDIC is doing and the national credit unions and tries to bake that into what the changes are going to be at Oakland. So, it'd be nice if we could get some of this guidance and get it out there and talk about it at the conferences. And I did, when you get to that subject, I got some other comments after talking with Phil Ferchetti.
Okay. David, we saw the form that comes out that asks the questions on certain factors in your loan policy. Can you share a little bit maybe on that?
Yeah, and I also want to speak to one of the comments that Brent made, and it was a comment we had in our chat as well. That it really, you made reference to that loan authorization, and I know that there was a great deal of comfort in the just because it was so prescriptive of what that loan had to look like. And I think the downside to that was the series of times that you would say that loan authorization would not quite match what was in E-Tran, or would not quite match the credit approval or the loan documents that were in. And so I get the idea that if this is something that could be produced by E-Tran, that seemed to be something that would be better, right? Because it would match E-Tran. E-Tran produced it in theory. But then in the conversations we had, it did sound as if like we were going to see something, but maybe between it. It didn't sound fully as if the loan authorization was going to come back, but it did sound like it was going to be a lot more than what the terms and conditions look like right now. And that seemed to be welcomed. I didn't hear anyone groaning over the idea that was, oh no. Most everyone was lamenting over it. At least that was what I
The
heard.
reason why it's important, David, is because it's the basis of starting the whole audit process.
Right. Exactly.
And the claims process and the wrap-up process. So
Mhm.
it puts everybody on, speaking the same language. So you can kind of map yourself so that you know what you should have in your file. And because, basically, SBA is an insurance company.
That's right.
That's
right. I agree. Yeah. And so, and a part of those reviews, I think that we saw, especially when it comes to looking at LSP oversight specifically, some of the items that were in there, there's a previous process. You just sent it to the email address, it would be reviewed, and then you'd get the yes or no back, and including feedback, whether there were issues. And the switch with Okram taking that over, and now there was a checklist that had to be reviewed, and you would, but really all of these items in the checklist, they were from SOP. This wasn't new, but it was like it was shining that light on it. And then the further addition of this kind of third-party risk management piece of it, and where Okram is going to look at these specifically. They gave everyone's a heads up on it. And then in some of what I've heard, the feedback we've seen is that in some of these risk-based reviews, it's as if they took that directly and said, okay, we say we're going to look at this stuff. What are you doing in your policy? How are you proving this? And I especially from the bank world, and this might be something that you've seen, or Michael, you might have comments on that, but it's one of those items that your SBA shop, depending on the ability they have to influence overall policy within the bank, that can often be difficult when you're not the major player in that lending space to be able to influence how you need policy to read so that you stay out of hot water. And so, but it does help. Like, again, the focus from the FDIC and other regulators that are really looking on those third party. If you have a nice, robust third party management policy in place already, then in some ways that meets those requirements. And it's up to you to just kind of point to how this general policy addresses these concerns that SBA has. So you just really, I think you want to be able to make sure that that's not confusing. You're not making anyone have to leap to a conclusion or guess what's going on there. And that seems to be the thing that's been the most helpful.
Yeah, and to go back to Hilda's comment, I admire the 504 process because there are those 3 looks, and they really, I watched my wife close for 2 years during COVID, and it's very detailed, and you're interacting with, counsel and a number of players and sometimes 7A should have a little, more that they like the guardrails. It's not so much that they've grown about them anymore. So I admire the 504 and the discipline that's in there.
Absolutely.
The closing process.
But
and the 504 has been performing, whereas the 7A program, the last time I talked to Eddie Ledford at the conference, emerging risk was the buzzword. And so let me ask the 7A lenders first, what are you doing to mitigate that emerging risk? And I know, Michael, you're a relatively new portfolio, but thoughts?
Well, and let me kind of step back just a second and talk about a little bit about what everybody's talking about too, because I think for me, I'm looking at things you're talking about emerging risk, but it's also, I'm looking at these things at 2 silos. I'm doing small balance and large balance. I think as an industry, we've done really well to continue to watch ourselves, for better words, of how we underwrite and how we manage risk associated with the large balance loans. Or even for me, I'm using outside counsel to ensure that I'm doing things on a national basis, because we're in a footprint of Connecticut as an example. Well, we may not know everything to do what is in other states. And so are we doing those things right? Where it comes to the small balance, you have to be kind of careful because you're not necessarily engaging legal counsel? Are you using a some sort of vendor to help you create loan docs or other things to make sure you're getting the right guarantees when you need to? Are you putting in the right verbiage when it comes to state specific language inside the note? These are all things for me are challenges that I'm learning. But as you get out there and then you start saying, well, I got to bring in the underwriting. And if you're doing this, do as you do, or if it's a scoring mechanism, I was more methodical as I built this out. I always felt like I've been doing this for almost 30 years. Cash flow is king. I got to kind of protect the integrity of that. And how do I build a small balance program that has that? Because I do feel like with these rolling back of some of the things that this do as you do, and then making some adjustments that we may get, in my opinion, pushing towards more of a cash flow perspective, even on the small balance. Am I prepared for that? Can I manage that and be able to continue to grow my volume and opportunities, but do right by all of us? And so those are the challenges that I see. Then to your point, Chuck, then you bring in these new changes with tariffs or different things that are happening. How do you blend all that out and kind of protect that with the overall arching thing? That one thing I want to say too, I didn't dwell on, but you're right. Manufacturing was a big thing at the conference. They also talk about these things of how, the 504 is going to be, you figure with equipment and real estate, how did that
That's right.
blends itself to the opportunity to help these clients grow with what the administration's opportunity of what they see over the course of the next 1 to 4 years. And so I think it's going to be a challenge for all of us to kind of step back and say what we've done, how do we direct ourselves and how do we manage these risks? Even as a bank, those are one of the things that are bringing out to me. It's like, I get these emails these days. Well, how is that going to affect your portfolio? Or what's this going to change things with these administration changes with the tariffs or those kind of risk associated things? So I think SBA is looking at it. The regulators are looking at it, but we should be mindful at the very bottom as we approach every transaction. How does this impact us and our, we still have to live by the zero subsidy. We got to put ourselves back to where we belong.
Yeah, we absolutely do.
And Chuck, can I add to that? I will say I completely agree that manufacturing was the word of the conference, is what it felt like. But something that was also brought up and mentioned, especially in that closing session, that one of the biggest reasons for failure kind of early on these is a lack of working capital, which is something that, especially within the 504 program, can't directly be addressed, right? And at least from the standpoint of making that available through a program. So I don't know, from your perspective, or I would love to hear everyone's thoughts on that. Like what's the way to address that need without making it sort of, it's almost like you're creating a different class of borrowers in that case, because that's what prior to all these changes and the push to try to make small dollar lending a lot more approachable, a lot easier, and a lot higher volume from it. We were seeing the average SBA loan size just creep upward and upward at close to $1 million at one point.
Right.
And so, which effectively means the true small business is really not able to get access to that capital. So what do you, I don't know, I guess, what are your thoughts on that?
Let me jump in here on that note. I mean, just a quick, observation. I think is an easy one is candidly, pairing up a 7A with a 504 when you see that there's an opportunity to do the both. We see a lot of deals, and look, I'm a supporter of all SBA loan products, and because I think they all have something to bring to the table and to help a business owner and help build our local economies. But the reality is, these different programs were designed to do specific things. And so, when you see perhaps one particular loan being used in a way where it's not maximizing on the efficiency and on that cash flow and being able to, help that long-term growth, sometimes I frankly do ask myself, well, what was the discussion around the table there about how we were going to best use all of the SBA resources available. So I think this is a tremendous opportunity to pair up 7A with 504s in a way where you're really, again, what I would refer to as maximizing on the efficiency. And really, I love, Michael, you hit on it. This is all about cash flow. Most of our deals, it is cash flow. And so how do you pair up those programs in a way that you're maximizing on that opportunity? Hilda, I don't know if you have any comments.
Actually, you were very nice about that, Manny, the way that you described that. The fact is, I think that these programs were thought the genesis is to help them to work together for the greatest benefit to the small business owner. And right now we're separating the wheat from the tares as we try and do that. So the fixed asset program, the 504 program, should be used for fixed asset so that we can give the borrower the opportunity to use the working capital program, the 7A program, for its best purpose, for them to generate working capital to serve the needs of their growth as a business. When you flip that and focus the 7A product on the fixed asset, you're eating up the opportunity for the business to be able to get the cash that they need for 7A, with 7A for working capital. And so hopefully this effort and the focus on manufacturing will help us to use the programs, I think, like they were originally designed to use. And I think that you're going to see a benefit to both sides where we're able to really help a small business owner to scale. I wanted to just mention one thing about the concern about how we're doing underwriting and the do as you do as a mission-based lender. And a smaller community advantage lender, where we are often thinking about that. Like, how do we make sure we're still able to help a small business owner to scale and give them the support that they need? And so one of our core values is prudent underwriting with a heart. We still have to be prudent. It's more than do what you do, it's do what's best for you to be able to continue to operate as an organization, but mixing a heart in there. And I often get slapped on the hand that I might have too much heart and I need to be a little bit more prudent. But we are committed to trying to create that balance to make sure that we can minimize loss to the program, but yet get this capital to the businesses that need it most. And I think it's really important as a member of the SBA family, as a partner of the SBA, to get that balance right.
Hilda, Chuck, let me just add on to what Hilda just referenced, because I think it's really important also for those who may be tuning in, Hilda's highlighting how lucky we are in the United States to have a very broad range and spectrum of lending companies, right? Hilda's organization is a CDFI, and it's also a certified development company. So, Hilda's doing some tremendous things in terms of what I would refer to as innovation in terms of the lending space. How often do we hear about patient capital and the need for more patient capital? And that's the heart that she's referencing, right? Recognizing that maybe a bank or even a credit union is not able to do some of the type of lending and investing that Hilda's group is doing, but you have these potential for partnerships. And we are seeing that. I mean, SomerCor itself, I'm very proud of the fact that, we're not a CDFI, but we just converted recently to a 501c3. And that was with the same intention in mind of how to best leverage the 501, the 504 loan program that we both use, and we leverage it really well, but now also offering other opportunities to our lending partners, right? On the CRA side of the shop, on the community development side or the philanthropy side, to say, okay, how can we achieve the things that we're looking to do in terms of building capacity, bringing reinvestment to some communities that have been hard hit, and not just in the cities. Take a look at, one of the things that I'm concerned is rural America, where you have fewer options to access to capital, making sure that we have these partnerships to fill in the gap. And so I think that's another exciting aspect to hear of what we're seeing is through these changes, is that you have these opportunities for these new models of being able to have a broader level of options and services for that very broad business landscape in our country.
What I'm hearing, we had record levels of lending last year, and everyone here seems excited for 2025 and 2026. Is that a fair assumption?
Yes.
Absolutely.
For
Okay.
sure. Yeah, absolutely. We're already almost double where we were last year in terms of our SBA Community Advantage lending. And so we're very optimistic.
Great. Well, I want to go back to one thing when we were talking about emerging risk. I don't want to be Debbie Downer, but I'm talking to 5 people here that know how to manage a portfolio. But again, Eddie Ledford said to me, he said that many of the lenders in the servicing functions are not reacting fast enough and watching, say, the Redwood score, and they're waiting until the loan goes past due. How do you, in managing your portfolio, what are you doing today maybe different than 2 years ago?
If you want me to tell you what I've been doing. So,
Please.
I use the Paris metrics extensively and particularly to talk to the board because it's also an educational document. So my servicing team, I instituted what we'll call biweekly problem and default loan meeting. What we now have is we have our loans in liquidation. We have our watch list, which also includes past due, the categories that SBA has. But then I worked on putting together a tool with Excel to take the data pack, drop it in on the quarterly basis, and I call them Louis loans under observation. And we pulls out the score. The Redwoods was with SBPS, but now it's Redwood scores, where I've seen a change in the Redwood score downward. So we have around 500 loans, let's say, I'm getting about 50 loans per quarter. They may change, some may go up and down, but the ones that go into this Louis loans, and I call all of them the LUM loans under monitoring, because Eddie likes names of stuff because that's what FDIC likes. So I call the whole package loans under monitoring, and then you got the categories, and then I take and try to cross-reference the Redwood scored downward movement so that I can identify loans that SBA would say. Now, I may have other things. So I'm working with CorpSmart, not to give them a plug, but they actually send us information about new UCC filings on our borrowers. So
Great.
we take, whenever we see new UCC filings on a borrower, we tag that loan as a possible, is it going to be a Louis loan or a watch list? Okay, so those are some things that I'm trying to do. So I went from maybe, 10 or 15 loans in liquidation, another, let's say 15, 20 loans in watch, and then there's another 40 or so loans that are these Louis loans, because there has been a lot of variation in Redwood scores, movements. So if you're in a portfolio of a couple hundred loans or 500 loans and you wind up getting 30 or 40 loans out of that, it's not a big percentage and they're not going delinquent, but it means you're not just looking at your, 15 loans in liquidation or whatever your number is.
How long have we had the Redwood score now?
I guess it's a year maybe, or just coming up on
when it first came out, there was some settling and some differences.
Last year.
Is everyone comfortable with that now? Because it is proprietary.
Well, it has a lot more factors in it. I think we'll see how it, we're going to see this next year, how much correlation is there with it, because it needed to have some time.
Probably more so than this year for sure.
Prove out. Yeah.
How about Lumos? Have you looked at Lumos? The portfolio management tool?
Well, we are starting to look at that. So we're trying to look at that and see how it integrates with, let's say, the Redwood.
Yeah. Okay.
You've been making us aware of features of that.
Manny or Hilda, how about you guys as far as the 504? It's been performing much better than the 7A program, but is there anything you've been doing differently?
For us, it's just a lot of attention to tracking not only our existing portfolio, but also, understanding the various industries that our borrowers are in, and just trying to, really paying quite a lot of attention to what's happening locally, but also globally, and then the impact that some of the stuff that's happening with a broader economy, how that's going to impact, potentially impact our borrowers. I think, for us and in particular for me, I have the luxury of having been a former banking commissioner in the state of Illinois when we were still dealing toward the tail end of the crisis, the financial
Yeah.
crisis. But then also, I think, a silver lining, if there's any, from the pandemic, was just how we all had to mobilize quickly at the early days of the pandemic, not knowing about whether there was going to be a CARES Act or not, and how we were going to have to manage our portfolio. There was we learned a lot of lessons from that, and we still implement those policies and procedures in keeping track of certain verticals. So, but as you said, thankfully, we haven't seen, our loans are performing, they're strong.
Yep.
And it's just a matter of staying ahead of it as much as possible.
Yep.
Yeah,
Hilda, how
well,
about you?
we actually do a weekly meeting with our chief credit officer and our portfolio management team to look at both our community advantage and our 504 loans. All are performing well. We've seen a little bit of we're watching closely our community advantage portfolio. We have our teams follow up whenever there is a late, if after 5 days we haven't received that payment, we're just really on top of it. We're very customer service oriented, and we have our entrepreneur ecosystem where we're pairing our business acumen advisor with that customer where we're seeing a slow pay or they have noted that there is some kind of a hiccup. We're putting a team on them immediately so that we can try and support them to get things turned around. We just did a survey of all of our clients asking, how are you doing? How are the economic changes impacting your business? What's your economic outlook? What are you projecting for business this year? Are you hiring? Are you considering additional capital?
Right.
And by and large, we have a very positive outlook from our business owners that have responded to the survey. They obviously, like everyone else, they're looking very closely at the tariffs and how they're going to impact them. Some of them had a little extra liquidity, so they started buying inventory before they saw the impact of the tariffs. But we're not taking anything for granted.
That's
And
great.
we're making sure that our technical assistance and business coaching entrepreneurship center is wrapping those businesses with service immediately.
Chuck, if I just want to add real quick on something that Hilda just hit on, touched on, is that's the other neat feature of working with certified development companies, is that many of us do have technical assistance, business coaching, and having that overlay and connecting with the small business lending centers that are part of the SBA network, as well as the SCORE group that we have as part of the SBA network. Those are all valuable resources that we are also tapping into and making sure that we're engaging borrowers, whether they're doing well or not doing well, but trying to be proactive and helping them. And that's also a significant value to our lending partners in the private sector side of the financing of deals.
Good. I remember the 2008, 2009 when I ran a CDC, and we would get our restaurateurs together in a big room and try to support them in different ways. So it's good. Brent, you had some conversations with Okram. Would you mind sharing some of that information with us?
Yeah,
before we wrap up?
Yeah, I'll quickly go through just a list of some of it we've talked about, but particularly in community advantage SBLCs and such, they don't have current minimum capital requirements, but the lender should review 13 CFR 120-471A4. So I guess there's a whole series of SBLC that goes from 460 to 464. Just review all that, because as you can hear earlier from Malk, they're going to start focusing in on these requirements. Also, they're going to be studying your loan loss reserve account and accounting. So make sure you understand how you're doing that and what's the basis for that and how often you're reviewing that. Make sure you review your Paris and/or SMART, that LMS report that comes out quarterly. They're looking at that. That's a basis of whenever they do a review. Make sure you have documentation of your delegated authorities, your reporting. If you have a warehouse credit line, even if you're a community advantage, what are the parameters there, and are you getting audited on that? And then, your securitization oversight and how you're managing any securitization issues. And then just one more time, assure you have a third-party vendor management process. Like I've developed a workbook that the team uses, and I do a little risk assessment. It's something I was able to pirate from my FDIC methodology, but it shows that there's a process from our compliance officer. Does the LSP, is there an LSP management and oversight plan? It also calls the SOP calls for a independent review of the LSP. And it's also requiring independent loan reviews. So I'll reinforce that. And then have the routine problem loan management. Start a routine problem loan management meeting, maybe twice a month. And then make sure you review secondary market rules. They're getting very specific about your confirmation of your lien registration. Might not be as big on the 504 side, but it's definitely on the 7A side.
Yeah.
It's a time issue because, since COVID, there's a lot of delay in getting the confirmation of your UCC lien. So that was the overall. I know that's a long list, but maybe you recorded this, Chuck, and you can.
I did.
I did send you a list of those issues, but that was
we'll
came
send
out.
this out to everyone.
Okay.
Michael, what have we missed so far? We're kind of wrapping this up. We try to keep it at 45, but have we missed anything?
No, and I appreciate what Brent is saying, because me, as starting a group, I came from a non-bank, and that was one thing I heard from Okram too, like the oversight and how like with a bank, you have federal regulators that are constantly in your space and making sure you're preparing these documents and you have controls. For me, coming over to bank too, learning about compliance and going through all these different compliance rules and checkpoints before I can even get a vendor onboarded and different things. You learn that, there's a significant amount of oversight that you benefit from being in a bank compared to being in a non-bank. So you have to kind of regulate yourself both ways. But we run into problems too, like just because it does and works this way under accounting rules or whatever, you still have to follow the regulators' rules. Same thing we're talking about with the SBA. I just want to make sure that we all need to make sure that we are reaching out to Okram, or reaching out to our SBA partners. And I also say, me as starting up, I've reached out to a lot of friends in the industry. How are you doing these things? We need to rely on each other because there's ever-changing things. Some of us don't always have the capacity to meet, greet, and talk to the SBA, but others do. We are a community. We have to support each other because this program is valuable not only to us monetarily, but it's valuable what everybody's talking about, getting money out to these people that need it the most. And we have to keep this going the right way. And this is important. It's been a great program for me in my career. I've been very blessed and met a lot of people, but I want to see it generational. Let's keep going. But we have to do right by each other today to accomplish that.
That's a very good point. Want to see it
It's kind
generational.
of like two families. You got about 50 or 60, I know you got more, but 50 or 60 core family members in NADCO and the CDCs, and you got a good 200 7A. And between those, they really, we should stay in touch with each other. Not that the other tertiary folks aren't important, because they are, but it's not a huge it's not a big family. It's a family that we should stay in touch with.
Absolutely.
And Chuck,
David,
and I
what have
was
we missed? Hilda, go ahead. I'm sorry.
I would just say on the for community advantage lenders and CDFIs, I think that we're kind of in a unique group we're part of the CDCs, some of us, but CDFIs that are community advantage lenders really need support and being able to collaborate with one another. So I would definitely encourage that. And I know upcoming, we have the community advantage retreat coming up, and Brent is going to be speaking there. It's really important to make sure that we can protect the integrity of the program by collaborating and supporting one another too.
I will see you there because I was invited to speak as well.
Yes, yeah, I should have admit, yes, you were.
Just yesterday.
Just a plug, just a plug. So
Well, we have some, David, what have we missed? Closing remarks from you, and then we'll just go over what's next month.
I think, oh my gosh, I'd love to continue just peppering you with questions. I know we're sort of at the end of that time there. So I think the wrap up was really, it sounded like on a more positive note. I do say reach out to the other industry professionals. And so for our part, we want to keep everyone informed as we're going through. I've already seen some messages asking, is there any way we can make sure we send that out? So I wanted to say for sure, Chuck, that we'll, if, everyone registered, we'll be happy to kind of summarize these notes that we discussed and make sure they're sent out. And also probably with it next week, you'd be able to get access to this recording. So if you wanted to go back and review anything we discussed, you would be able to.
Manny, what about you? Closing remarks.
It's I think it's an exciting time, and there are some great points, and I just want to underscore what Michael just referenced and what Hilda just referenced. Really, this is an ecosystem. We do well, we do best when we collaborate with one another, and just looking forward to continuing to grow our partnerships.
May is going to be a good month. We're going to have NADCO and we're going to have NAGLE. And next month, our 30 at noon is going to be with Lindsay Rowland, partner at Starfield and Smith. Again, talking about emerging risk. Don't want to keep harping on that, but she's going to talk about loan liquidations and some of the challenges that they have with landlord waivers as one topic. So stay tuned. We'll make sure everybody gets a copy of this. And thank you so much, all.
Thank you.
thank you all.